there, and welcome to lesson 3 of 438's Forex trading course. Now, just before we get started, I was looking like a brief recap of what we've covered in the last two lessons, so just tie in everything together. Right? Like to kind of tie everything together, right? Because it's all a part of a bigger picture and a bigger story that I'm trying to paint for you guys, right? So we have gone through what the Forex market is, it being a market where the mutually exclusive price or the mutually agreed upon price is the exchange rate. We have gone through how to read and quote the Forex pairs. We have mentioned that they're trading in pairs, right? Two currency, you trade against each other or trade for it, right? So it's in pairs. We would have also mentioned how we make money. Just like anything else, you want to acquire or buy at a lower price and sell at a higher price for a profit. And it's the same thing, right? But I mentioned that advances in technology has made it easier because it used to be an exclusive thing for the big boys with big money. Now with leverage and margin and just brokers, a regular man can start trading Forex with $10, $20. And that I've also mentioned, in order to make money, you have to buy a lot of the currency, and that's where the brokers and the leverage and the margin come in to allow you to be able to take on those positions where you're trading a lot of the currency, right? A lot of the units of the currency. Now, I'd have mentioned that. So fundamentally, we'd have mentioned how you make money, but then how do you determine what to buy and what to sell, or when to buy and when to sell? And I would have gone through the two main methods that we use. So we have technical analysis, which is the use of historical data, historical price, what price has done in the past to kind of determine what it will do. And I've also gone through fundamental analysis, right? Which should have been, it's not even the two methods. It's actually they have to be used together. I mean, there's some people who probably don't focus on technicals and just use the straight fundamentals. And there are some people but I kind of use both of them together, right? Because how I think about it is that technicals will show you evidence of what the market might do, but the fundamentals is actually what makes the market do it. So you expect the market to move up $10, fundamentals tell that it might move $10. Sorry, the technical analysis is telling you it might move $10, but what actually moves it is the news that comes out. News come out, inflation has gone up or gone down, and the market reacts to it and moves at $10. Right? So they're kind of used together. Now, I've mentioned that we use historical data. So this lesson is going to be around how just setting the foundation for the technical analysis, how we use the historical data, how is the historical data represented, or how historical data is represented, and how we are able to consume it and use it. Now, we use charts to read the historical data, historical price movements. We use charts. The chart is made up of, let's bring up on screen, the charts that we use, and there are different methods, but the charts that we use have what we call a Japanese candlestick. Now, a Japanese candlestick has 4 main components. There's an open price, there's a close price, there's a high, and there's a low. And there's also the time frame that the candlestick is being formed in. Now, that's very important because price is always related to time. This is the price. The context is within the context of time. This is the price of the unit of currency as at this point in time. And of course, it constantly fluctuates, it moves. So a candlestick then represents the movement of price within a particular time period. So, for example, on screen, we're on the 1 hour time frame. Each of these candles here represent the movement of price for a specific hour. So for this hour, the hour from 5, so Friday, the 16th, 2024, between the hours of, from 5 a.m., this is a.m., might be a.m., from 5 a.m. to 6 a.m., this is what the price would have moved. All right, the price would have moved from here all the way up here. All right, so let's go a little deeper into the anatomy of the candles. Let me just pick one of these candles that is a little easier to read. And then the type of candle. So there are two high type of candles. And there are other two main types. You have a bullish candle, I have a bearish candle. How I like to think about bullish and bearish, especially here in different financial, environments and settings. The bull attacks so the bull will attack like it will go down and then go up. So once price goes from down to up, once the candle starts lower and closes higher, then it is a bullish candle. If the price, however, does the opposite, is a bearish candle where bear attack from up. So the bear goes up and then slams down. If the candle opens higher but then closes lower than where it opened, then it is a bearish candle. Right? And then that kind of helps us to segue in the first two main parts of the candle. So a candle has an open. So I'm gonna lose this one. A candle has an open, so the candle opens here. So it's our open price. So you guys can see this red candle. We got this red candle. The candle has an open price and has a close price. So for example, this close price would have been 24.8716, but it actually had open at, so for the start of this hour, it opened at 29.9462. But then if it closed down here at 24.8716. Alright, so this is actually a bearish candle. It closed lower than where it actually opened. Now, within that hour, the price also went all the way down here. So I was thinking, remember, the candle on the 1 hour time frame represents the movement of price within the hour. So even though the candle closed here, it had gone down here. The price had gone all the way down to 24.7752. And the highest, so this would have been the tail of the candle, or the lower wick. Because it can look like a candle. It have a body and have wicks, right? It have two wicks. So the lower end of the wick is what we call, this is the lowest price that it went. So this is the lowest price within an hour. Now, it also has a upper wick, which is a little small. It's kind of hard to show. And it would have closed up here. This is the highest would have gone in that hour. And that's essentially for the candlestick. And these things, they mean things. In terms of how it closes, which we eventually go into. But this is historical data. So for this, and it gives you historical information. For this hour, between 8 a.m. and 9 a.m., the price did this for that hour. It went all the way down here. So it opened here. And looking at the candle right now, it wouldn't tell you which order which happened. It doesn't matter either. So there is no way to tell specifically, unless you want to go down to lower time frames. That's what you can tell, because the candles are actually made up. So I don't know what the term is for that, but just like our time, but in this case, time is represented in a finite way. So it's been represented in it's opposite of continuous. Can't remember the term, but it's, for lack of a better, I don't remember. Correct me if I'm wrong, but it's been represented in a finite way. So a 1 hour candle will be made up of 4 15-minute candles. So that's how we define time, right? So there'll be 4 candles that's been represented that make up this 1 hour candle, right? Let me just show you what it would look like. So let's look at this. If I go down to the lower time frame, this is it. So this is actually the 4 candles that made it up. Let's make sure I'm doing this right. 15 minutes. Right, so this is the low way. So if I wanted to see what time it actually went down here, you see that it actually went down here between the hours of 9 and 9. No, actually kind of wrong thing, This actually shows when the candle actually closes, right? So yeah, it would have actually, when it opened. Yeah, so that's how you can look at it. But again, you don't necessarily need to know. You just need to know. All right, so you see how these are color coded. Usually, I actually change the colors on it just because I was going to go to this video. But usually, my charts are black. Like all the candles are black because I can tell what a candle is based on where it opened or where it closed. So let's give you a little trick. So wherever one candle opens, that's where the other one closes. No, wherever one candle closes, yeah, right, the same thing. So this candle would have closed here, and that's where the other one opened. So once I know where the open is, obviously I can tell where the close is. And once I know those two things, I can tell what time of candle it is. So this candle open up here. So this candle, so I might need like 3 to tell you. All right. So this candle closed here. And remember, time is going from, you're reading charts from left to right. So time is progressing from left to right here. Time is on your x-axis, price is on your y-axis. So the candle actually, this candle opened here, closed here, so it closed higher, so it's a bullish candle. And then this one would have opened higher, but it closed lower, and so it'd be a bearish candle. And essentially, that's what the candlesticks are. I said, I go further into how we use these patterns because the candles can create patterns and give an indication of where price could possibly be going. All right. And as I said, TradingView allows you to chart and monitor the price. You're not seeing any movements now because the market is closed. The market is closed on the weekends. So market open from Monday to Friday in our time. So it's closed. Now there are different time frames up here. There are multiple time frames. You can go as high as on the weekly. And on each time frame, what the candle represents is the movement of price for that entire week. So the market would have opened down here at the start of the week. It closed all the way up here. And then the little wick would have shown you the lowest point it went in that week, highest point it went in this week. And as I said to you, candles are made up of other candles. So a 1 week candle would have been made up of 5 daily candles because there are 5 trading days in the week. All right, so it's 5 candles that make up that 1 week. And the same thing for let's say the 4 hour would have been made up of 4 weekly candles, 4 hourly candles. All right, so this last hour here would have made up of 4 hourly candles. So these last 4 candles. And same thing for 30 minutes. 30 minutes made up of 30 minutes makes up to 30 minutes makes 1 hour. All right, so it's kind of how you think about it. Now, right, so that is important to know what the candles are, what they represent. And it tells a lot of things, right? So again, I don't want to necessarily go into strategy. I just want to give you guys a walkthrough of TradingView. TradingView is actually free, so it's tradingview.com. I have a subscription because I need to actually pull down data to do something. You don't necessarily need a full subscription to use it. The basic features are there for you to be able to use. So the next key thing I want to get into is market structure. Now there are 3 main market structure, and structure does represent like how the market put structure the market as it suggests. All right. So let me go quickly and just show you. The market can be an uptrend, a downtrend, or it could just be consolidating. All right. Since we're here, let me show what that consolidation looks like. Right now, remember we're on the weekly time frame, right? So the market here is representing, each candle is representing a week. So this is from November 2023 all the way to February 24. How much months that? I don't know. 4 months? But for that 4 months, the market was pretty much stuck between this price. So a price range of, let's say, 262 and about 819. I'm putting so about $60. So the price was in a range of $60 where the price was just stuck here. This is consolidation. And you want to stay away from these areas where the market consolidate because there's not much to read. It's hard to kind of read the market when it's just a consolidate and just stuck between a level, 2 levels, right? Now the other main market structure is what we call an uptrend. Now, what is important to note about the uptrend is an uptrend is characterized by, if you go on Google and look what the uptrend is, it will tell you that a market is in an uptrend when it's creating higher highs. So it's creating higher highs, and higher lows. Now, I don't necessarily focus on the higher highs part of the definition. I more so focus on the higher lows part of the definition. Right? So let's say, for example, the market create this is a low of the market right here. So this is a low, it's a low, market push up. So it has pushed up and has created a new low here. Call this entire area here a new low here. Alright. Or let's say it created a new low here. So this is a higher low. It's a higher low because it is higher than the last low. So it's a higher low. Alright. The market would have then pushed up and created a new high right here. It came back. Even though it's slightly low, it's slightly higher, it is in fact higher. So it's not created another higher low. And once the market continues to do this, it is in an uptrend. Right? It pushes up again, created a new high, higher high, and also created another higher low. So once the market continues to create these structures, once the market continues to create these higher lows, it is in an uptrend. Even if the market does not create a new high, because it could be a new high, it doesn't necessarily have to be a new high, right? But once it continues to create these higher lows, that's kind of how I look at it. Right, so that's that. So remember the definition for the market uptrend is that the market is creating higher lows. Now let us look at opposite of it. When the market is in a downtrend, the market is creating lower highs. Lower highs. So there is one high here, the first high, and like you can use a trend. You can use what we call a trend line to kind of for your on-trade highs, right? Because I have more experience with the market and my eyes are trained to see it. In order to aid with the visual, you can add a trend line to the chart. All right. So the market created a high here, pushed down. It created a new low. Again, if you go on Google, it's the definition of a downtrend. You tell the market when the market is creating what we call it is creating what we call lower highs and lower lows. It is in a downtrend, and that's what they'll tell you. All right. So if I guess look at it, it's just a collection of like candlesticks, and it's creating these patterns because the price is always moving, it's fluctuating, always ever moving. Once market is open, price is never constant. So you have a high there. It came down here and created a lower high. Why is this thing not working with me? Move. It created lower high. And it creates, it's also been creating another lower high down here. So it is in a downtrend. It is in a downtrend. Downtrend. So another lower high. And that's what I focus on, the downtrend. So the market is creating these lower highs, it is in a downtrend. But what do you guys notice here? So the trend line, and for it to be a valid trend line, it has to have 3 touches. So there's 1 touch, 2 touch, 3 touches. All right. Now, look at this. The market if the market was following, if the market was to continue the trend, what do you think was supposed to happen here? When the market came back up to the trend line, we'll call it a retest, to retest the trend line, it should have in fact continued going down. Right? But what happened? The market pushed right through and it took out this lower high. And that's what we call a break of structure. So how you know when the market has changed structure? So the market was trending down here, right? But what has happened? It broke that structure. I remember when I was saying when the market's in downtrend, it's creating lower highs. But this last push here didn't create a lower high. It actually created a higher high. And once it does that, once it's broken this trend, again the trend, what the trend is, this series of lower highs. Once it breaks that trend and creates a higher high, it has no broken structure. So it breaks the structure here. Or at least it's a broken structure. Now, how we confirm that it does, how do you confirm that the structure has been broken? is what it does next. So it creates the higher high, but then it could have, the market is bird. Again, the market can do anything it wants to do. So it could have created this higher high, but then still continue to fall. What did it do? It falls in line with our uptrend definition. It created a, and what you can guess, it created a higher low. But now this is a low, it pushed up, created a higher low, and what happened after that? It come up here and it created what again? Higher low. So the market has changed structure. So the market broke through, took out this last high, created a higher low, push up again, create another higher low, and it's broken structure. And that's kind of a lot of what I do is trade breaker structures. It's either a breaker structure or a continuation of a trend, right? So it's one of two things. Either it's a breaker structure or it is a continuation of a trend. All right. The next key piece of thing that you need to know is what we call support and resistance. So support and resistance pretty much represent what we call price floors and price ceilings. So support, what you call a price ceiling. Sorry, a support, what you call a price floor. All right. So I've already put on these, and the fun thing about it is that so price ceiling. So price goes up, hits it head against it, and falls. Ceiling, can't go past ceiling. Price floor, price goes down, drives into the price floor, and it pushes back up. All right. There are other names for these things, which I can eventually go into, but the other names for it, some traders might call it supply and demand zones. Just one of the same thing. It's just, yeah, pretty much one of the same things. But then what is key to know is that support can become resistance, or resistance can be some support. The market is fun like that. So the market pushes, so the market would have respected this twice. So it came here, push up, pull down, respect this again, came back down, push up, but then it broke through it. What it did, when it broke through the support, it came back and tested it as resistance. So it pushes up in there and hits its head against it and drives back down. Then what does it do? It gets enough, so it created, so there's another price floor here. So support area is here. One drive, two drives, three drives, can't break through. So it pushes back up, comes down, and it retests the same area that was one support as support again. Or it was once resistance here, it's no support again, and it pushes back up, and it continues to do that over and over. All right, and these are the things that you want to look to. So essentially, you want to be buying and selling at these areas, these key areas. Now, I mark them a little different because I mark this as a weekly high. Again, when I get my strategy, I'll show you. I mark it as a weekly high. You want to be, so remember what tell us say, if you're going to buy, you want the price to be going up. Maybe I'm not sure if I said that earlier, but there are two actions you can take within Forex. Either going to be going to a buy position or a sell position. What you need to know is that when you go into a sell position, you expect the price to be falling. And I can go into the back end of it. You don't need to know that necessarily. But when you are also, when you're going into a buy position, you expect the price, you want the price to be going up. When you go into a sell position, it's because you expect the price to be falling. So here, when price hit levels like this, like hit the support here, price action is telling us, I will call it again, it's price action. What price has done before is telling us that it's supposed to be going up. So you want to be taking buys at this area. Buys. So you set the price to go up, and so on and so forth. Same for the resistance area. Market hit its head in there before and fell down. You want to be taking sells here. So you want to sell, so you want the price to be going down. Here. And all of what you see now is called price action. Using what the price has done before. Again, if you see the price broke through this. So it was one support. It broke through it to expect the price to reject it. Or at least you're looking for this area somewhere the price is going to react to. So there's even that. The reaction doesn't have to be a rejection. Reaction. I mean, it could have slowed down, it can break through it, whatever it is, but you expect a reaction of the price in a specific area. And that's what price action really is. Using what price has done to determine what the thing is going to do in the future. Yeah, that is essentially it. I went through all the things. I went through TradingView. I mean, Yeah, TradingView. You can add. You can, so these are the two pairs I trade. So they're on here. You can actually look at other pairs. You can type them in. In fact, you can even use TradingView to trade, but I don't necessarily use it to trade. There's specific brokers that's supported by it. Let's say, I mean, you probably wouldn't find a JMD. You probably wouldn't find a pair like this on there. You probably wouldn't. It's actually here. Oh, you see that? You see that? I didn't even know this pair was even here, but it's a Jamaican pair. I can't add it. What is this? It look like I can't add it. Not sure why. Yeah. But I spoke to you guys about our USD JND pair. Look at mechanic. But let's try another pair like Euro USD. And when I so if there are multiple, so it's data, you know, and it's the trading usually like data center. They're different data providers, right? So Forex, I use FX. You want to use FXCM. Click on add, and it will come there. Click on it, and the chart will be here. See, I used to trade it, or at least I was trading it, so you see stuff on there. But yeah, essentially, you can add most of all the major pairs are here. I just don't know why it didn't allow me to add Jamaica. Probably didn't support it, or maybe our data. Not, I mean, our pairs are not so widely traded, not very liquid, not a very liquid market, which is why you probably wouldn't. That's crazy. Now, which is why the spreads are so crazy. I saw an article come out today about banks, the spread that Jamaican banks offer. I would have spoken about spread in the first few episodes as well. Spread is that the price of the banks buy the currency for, they sell it to you for it, is a spread difference between it. Now you find that liquid markets, like some markets have lower spreads versus, so the more liquid the market is, mean that the more supply of the currency that you have is less opportunity for arbitrage, which is what is actually happening. It's less opportunity for arbitrage. Don't kill me if that's the wrong term, but it's less opportunity for us for them to be able to take advantage of widespread, because there's so much currency in the market. It kind of doesn't allow you to be making a lot of money because there's so much. Again, it's a supply and demand thing again. Right? When the currency is scarce, you may find more opportunities to be able to, or buy it wherever it's not so scarce and sell it back to where it's scarce at a higher price, type of thing. So like current, this is what about USD is one of the most traded currency. The spread on this is really small. So if you look at it, you see where, all right, so this is where you look at it. So it will show you what the price is when you're selling versus when you're buying. So it's always higher. So that's the spread. Same thing with the banks. When you go into the bank and you buy the currency, you're going to buy at a higher price than if you were selling it. And that's how the bank makes their money. The spread here is like 5.8. All right, so the spread comes up 5.8. This is probably one of the lowest spreads. You may look at us, they might have a higher spread. Look at the spread on this. Spread on this is 20.6. So the more liquid the market is, the lower the spread. The spread on this is like 82. All right. But yeah, essentially, that's what's happening. That's what's happening. All right. So this is TradingView. I mean, I use it for the sake of. I'll probably show you the other things that I use when I get to the market strategy. I show you the other tools I use. Where we'll call a long and short position. You guys will probably see me have. They call it. Let me just show you that one, just to know. You guys will probably see me have my long and short position tool. So, for example, let's just say I expect price to fall here. So I'm going to go in a sell position. I would go to the short, because short is sell, long is short, long is buy. Let's then enter here. Expect the price to come all the way down. So this is usually where I expect to exit the trade. So here is when I want to exit the trade. And this is where I put my stop loss. So let's just say the market moves against. Remember I said I want the price to go down, right? What if the price goes up? If the price goes up, I lose money. That's where you lose money. The price goes up, and as long as the price continues to go up against where I decided to sell, I'll be losing money. Further it goes away from where I decided to sell, I'll be losing money. Again, I don't want to go into the back end of it, because you don't necessarily need to know it per se. but you put a stop loss. And stop loss is pretty much how much are you willing to lose on this particular trade. So my stop loss here is 42 pips. Because I've described what pips are, 42 pips. So the price move 42 pips against my position, it will automatically exit, keep me out. Again, I'll show you on the trading platform. I haven't gotten to that point yet. All right? Because we don't reach the point for end the trades yet. So you want to get this part down, Pat, before you think about entering trades or even putting money in an account. And then this is where your take profit is. This is where you exit. So you say, okay, if the price come back into this level, I'm exiting at this point. It's actually I'm actually trading this in. Who knows? It kind of looks a little. I can do this in front of us sometimes. See, it looks promising, especially because what you have down here is what you see. This is resistance. This was once resistance. The price couldn't break above it. It broke down. It may come back and test it, or there's liquidity still here in the market that it probably wants to come and take up. All right. Especially because there was this massive run up. So usually the market is that there are things happening in the background that, again, you guys don't necessarily need to know, but it's just for educational purposes. You see how the market like push up right here rapidly in this hour? What may happen is that there's some of these, so there may be persons here who had positions here to sell or not to buy. But because the price moves so fast, they may not all have been filled. So they're unfilled orders here. So the market naturally is going to come back down to this price to try and fill back the orders that were left. So that's essentially what happens sometimes in the price when resistance becomes support, like come back and take up back the orders that were left. And you want to, what I try to do is have a 1-to-3 ratio. Again, when I reach into the risk management portion of it, again, when I reach nowhere near that yet, risk management is around like trading. I just want to get the basics and stuff down before we get into that. But yeah, essentially that's what a sell position would look like. Now, as it relates to a buy position, let's just say that I don't know. I did feel like the market about push up from here, so I decided to put it there. So I set my thing right here. I want to go back all the way up here. All right, so you can see my stop loss is below here. And they push up. So when you see it going up like this green, it would have been that I have up 30 pips in profit. And I'm going for 100 pips. And the ratio is 1 to 3.38. Yeah. But yeah, essentially guys, that is just a kind of roundup of what essentially a roundup of what basics of candlesticks that we're using price action, TradingView, which is the charting tool, and the different marketing structures, uptrend, downtrend, and you want to trade with the trend. So the strategy I use is a trend following trend. So the market is trending up. You don't want to be selling it. The market is trending up. You want to be buying the market, right? Market is trending down. You want to be selling. Consolidation. You want to stay away from that. And I mean, there's some people. There's sometimes I counter trend trade. So yeah, let me show you what a counter trend looks like. Actually, you have people who counter trend trade, and that's if you're really skilled. I do some of that sometimes. So if you, again, I try those usually get so bright, really bright, but usually so bright. But a counter trend, so when the market is in an uptrend, right, the market actually has to pull back. So each time it pulls back is what they call a counter trend. So let's say, for example, this setup here, the market is actually in an uptrend because there's a low, higher low, higher low, higher low, higher low. It's in an uptrend, it's trending up, right? But then there are also these counter trend lines. So each time the market pulls back to create a new low, this is a counter trend. Counter trend. So you can decide to sell the counter trend, but it's a little risky because you don't know where the market is going to create a new low. All right, so you can just continue. You can just flare upon you. All right, so you want to stay away from those areas. One more thing I want to go through now is the trading sessions. So I think I mentioned in the first few lessons that the market trades in sessions, right? So from Monday to Friday, in what we call trading sessions. And these trading sessions literally are the times when the major financial systems or major financial markets in the world are active. They're probably like four major financial centers. So just where most of the transactions are happening, money is moving around, stocks, bonds, all that stuff that's happening is in these major financial centers. So and I have an indicator on my chart. So like indicators like an application. So they're built that you can use on TradingView. There are multiple indicators. I don't use them. I don't use indicators. Right? So I didn't want to mention any of them to you. But people use them to trade. Usually indicators that they're lagging because they use past data. So it's a little lagging. So if you look on the line, it raise their colors, right? I'm gonna go lower so you guys can see it better. So this session here, this yellow session here is what we call Sydney. This is the worst session. Slow, dead. Volume is low. Volume, and when I say volume, it's liquidity. There's not much money being moved around, not much transactions being taking place, not much currency being traded. Very slow, dead. All right, and then we have Asia. So this purple looking blue is Asia. So this is over Japan, them China, Asia session. One of the biggest session, but one of the longest one as well. And this is what is Asia. This color, this white space is where the two sessions cross over. And that's usually when the market is most active, most volatile. When two big sessions cross over, meaning that they're running at the same time, you have a lot of stuff happening. So then this second one is London. So London, one of the biggest financial centers in the world, London, or Europe, whichever one, called London session. And then the crossover between London and then this is New York. America, America, the largest economy in the world, one of the biggest financial centers in the world as well. And so this is it. So this is how I use it to, you don't need, once you have this indicator on your chart, you don't need to know the time. I'm not really busy. So I just put it on, make sure that my time zone matches to where I am, and just work with it. And you will adjust the time zone once you put the indicator on. Makes the chart a little bright, but it gets the job done. But yeah, so that is actually it for today's session, guys. If you have any questions, you can leave them in the comments. Yeah, leave them in the comments and I will answer them the best I can. So until next time, and again, if you made it this far, congratulations. It's the boring stuff. I know a lot of people don't like the boring stuff, but this is essential for development and stuff, right? So until next time, SJ Fibonacci out.